Hi there, this is David Hillier here, and I'm going to give you a quick video on how to calculate the weighted average cost of capital using real data. Now, I'm not going to go into the real technical difficulties of identifying what a cost of equity capital should be or what a cost of debt capital should be. I'm going to give you a very quick approach to finding the weighted average cost of capital. So for the purists out there, I apologise. This is really just a 10-minute quick approach to get that weighted average cost of capital for a company. Now, to start off, we need to know what the formula is for the weighted average cost of capital. So you can see that here. You've got two components to it. You've got the part that relates to equity and the part that relates to debt. Now, if you have several classes of security, then you could expand that into 3, 4, 5, 6. Like you might have preference shares, or you might have different hybrid stock. But I'm just taking a very simplified approach. I've got equity and I've got debt. Now, with debt, we use the after-tax cost of debt, and I covered why we should do that in past lectures. Now, the two parts to the equity, as you can see here, this is the weight of the equity in the company's capital structure, and you have to use market values if you've got them. This is a cost of equity, and there's different ways you can calculate the cost of equity. You can use historical returns. I'm going to use CAPM here, but there are a number of ways in which you can do that, and I've covered that as well in previous lectures. This is the weight of debt in the company's capital structure. This is the cost of debt. Now, the cost of debt would be I suppose the R, or the yield to maturity of the debt. But you're not going to get that for a company, because a company will normally have many debt issues, and I'll show you this for the example Carrefour. So you've got to take an estimate. The best way to do it is to go to the market and get prices, but the thing is, debt isn't traded that often in many markets, so it's a very much a subjective thing, and I'll show you what I do if I want to do it very quickly. And then you've got 1 minus a corporate tax rate. Again, you would use the marginal tax rate here, but the problem is that many companies trade throughout the world, and so the one individual tax rate, it only applies to one country. So again, you've got to use, and what I usually do is just an effective tax rate, and that's a good way a first step to get the weighted average cost of capital. So we're going to look at Carrefour. We're going to use real data. So today's the 22nd of May 2015. And the first thing we do is we need to go to different websites to find each of these different data points. Now, I'm going to also work with Excel here. So for the first thing we want to do is to get the market capitalization of the equity. That's the S that I'm looking for. Quickest way to do that is to go to any financial website. I've got let me see, I've got Reuters here. So in Reuters, one of the things you do is, now the thing you can do is you can just search for it up in the top. You can do car, you can see Carrefour. It's let me just put, yeah, Carrefour Paris Stock Exchange. And you end up getting this site here. You can find it there, yeah. Now we want to find the market value. So you just go down, and from here, the market cap in euros is 23.377.61. So I'll put S is equal to 23 point, I always forget, 377. 0.61. Just make sure that's right. Yep. Okay. There's S. Right. Now, okay, so we've got the market capitalization of the equity. Now that's in millions of euros, so let's be careful of that. Now the next thing we're going to do is calculate the cost of equity. Now we're going to use CAPM, so the CAPM formula is the expected return on the equity is equal to the risk-free rate plus beta times the market risk premium. And the market risk premium is just the expected market return minus the risk-free rate. So we've got to calculate three things, or find three things: the market risk premium, the risk-free rate, and beta. Now, the market risk premium, you're looking ahead into the future. You're anticipating what the market return will be, and you know as well as I know what the future will be. So just for simplicity's sake, I would do a bit more analysis and looking up the news and looking at what analysts say, but I'm just going to assume that the risk premium is 7%. Now we're going to have to find the risk-free rate, and we're going to have to find the beta as well of the company. But before I do that, I just want to put the market risk premium in. So RM, ERM minus RF, and we've got 7% here. Now I want to calculate RF, or find RF, and I also want to find beta as well. Now, to find RF, when you're looking to find the weighted average cost of capital of a company, you want to match the risk-free rate with the normal investment period of a company, and for that I would say the 10-year rate, and you find that in ft.com. So if I go to ft.com, now let me just take you to the front page. There's the ft.com. I'm going to click on markets and then markets data. And in markets data, I'm going to go to bonds and rates. And then from there, we're going to look at government bond spreads. And Carrefour is predominantly a French company. So let's look at what the French 10-year government bond spread is. And bond yield is 0.94%. So it's really low. And in 2015, the rates were really low. So I've just forgotten what it is. We're at France, 0.94%. That's actually allows you to work out what you think the expected return in the market should be. Well, it's just the expected return in the market is equal to 7.94%, because if the risk premium is 7%, we add on 0.94 to get the market return. Now the beta, where do we get the beta? Let's go back to Reuters, and we can find the beta of Carrefour. There's Carrefour here. The beta of Carrefour is 1.25. So that allows us to work out the expected return, or I'll just leave it like that, or the return on S, this part here. Okay, so it's the risk-free rate plus the beta times the market risk premium. So our equity cost of capital for Carrefour is 9.69%. Let's move on to the debt component. So we've got three things we've got to do. We've got to find the market value of the debt, we've got to find the cost of the debt, and we've got to find the effective tax rate. Now, the problem with, as I said earlier, the cost of the debt or working with debt is that you don't actually have market values, and when you use the weighted average cost of capital, it is market values you've got to use. So you can't. You basically what I do, again, being very quick, is just go to the company accounts, Carrefour's company accounts, and then find out the total value. Well, different ways you can do it. Total value of the long-term debt, and because that's the financing component, and the cost of debt. So let's work with the first part, which is the value of the debt. Now, what I did is I downloaded the most recent registration document. I just went to the company's website. It's 2013. That's the most recent data I've got to do this quickly. Now, clearly I would want newer data, but that is all I've got just now. And you scroll through to find the value of the long-term debt. I'm just firing through. Oh, here we go. And here's the notes to the accounts. Now if I prepared this I would have known where the page was, but I haven't because I've just put the companies together. Income, right, okay, we're getting close to it now. Okay, consolidated statement of financial position, 136. Here we are. Right, okay, so we've got the assets here. We want to find the liabilities. Non-current liabilities, total non-current liabilities is, now you've got to make sure that it's the right currency. So I would say 13.454. Now, one thing you can look at is look at the short-term borrowings, because if a company's rolling over short-term borrowings all the time, then you could argue, well, that is actually a financing. That's a type of financing. And so therefore that is financing the operations. So and you can also, in a sense, you can do that with creditors as well. If you look at the creditors, it's the same amount year on year. Now, I'm not sure, I haven't gone into this in as much detail as I would normally if I was doing it. But what you're looking for is you're looking to see, well, okay, how much of the company's operations are financed by long-term debt and short-term debt. Let's just go for, I'm just going to work on the debt. So I'm going to use 13.454 plus 1683. Okay, so that's why, because I've got the non-current liabilities. I'm assuming that's just all long-term financing. I can see the long-term borrowings here, but I want to use just the non-current liabilities plus the short-term borrowings. So it comes out to be, if I add these two together, 13.454. Let me just write these down. So we've got debt is equal to 13.454 plus 1683. Okay, 13.454 plus 1683. Now that is in millions of euros. S was in millions of euros. So now that we've got both of these, we can actually calculate the weights. But I won't do that yet because I want to work out the cost of debt. Again, I would do a bit more analysis than I'm actually wanting to do here because of time. But this is about speed. So I'm going to search for bond. So let's see. So you can see that I've written that here. There's a lot of bonds in here. There's 85 matches. And I'm just going to fire through until I find a listing. Now you notice that there's some bonds mentioned here, but these are bond buybacks. So they're bonds that were due. So they're quite old bonds. And I'm wanting to find more recent bonds. Again, we've got stuff here about buybacks. If I keep on going through, you will, usually in a set of annual accounts, you'll get details of the actual bonds that are issued by a company. It's presented in different ways, but usually you can get some information here. These are some assumptions, but that's for pensions. We've got bonds and notes, so we are getting, there we are. So here we go, bonds and notes, and these are all the different bonds that Carrefour has issued. The longer term, well no, the more recent ones are towards the end, and I'm seeing here that there's 3.875, 3.875 for 1.75. Now again, can you just take those coupons as being the cost of debt? No, you can't. It's not a great measure because you don't know what type of bonds these are. You don't know if they've got call options, put options. You don't know if they're hybrids. You just don't really have much data. So, but I'm looking at all of these and they're roughly about 4%, 3.875%. So let's just go for a cost of debt of 3.9%, roughly. Okay, I'm just taking a guess here, but 3.9% of roughly 10 years bonds, because if that was a 10-year bond, then that was issued in 2010. That was issued in 2010. So let's just go for a 3.8%. I think 3.8% because since 2010, the risk-free rates have gone down. So I think these, if they were to issue that now, it would be a bit less. So 3.8% is what I'm going to use. So we can call RD 3.8%. And now we're going to work out the weights. So the weights of the equity are equal to 23 divided by 23 plus 15. So equity is 60%, and that means the debt is equal to, well, you can do it two ways. I can do 1 minus this figure, or I can actually just do the calculation itself. So you can see you get the same figure. Right, one more thing, the effective tax rate. So we'll just call it TC. Now where do we get that? Well, I would get that from Reuters. Now Reuters, you would need to go to, let me just see if I can search through this. Go to financials in Reuters. And this is all Carrefour. And if you scroll all the way down to the bottom, you'll see, let me just see, effective tax rate. Look at the size of this tax rate. So you've got the company's tax rate, you've got the industry tax rate, and you've got the sector tax rate. So in the last 12 months, TTM is trailing 12 months, it's 35.94%. Over the 5 years, it's 73%, so it's a big change. But the company's effective tax rate, the industry effective tax rate is roughly about the same. So I'm going to go for 35.94%. So this now allows us to calculate the weighted average cost of capital. And what I'm going to do is I'm going to just copy this formula so you can see it. Put it here. There we go. It's a bit big. But there we are. And now let's, so we've got S divided by S over B, so we've got that. So let's see that R, or the WACC, our WACC is equal to the weight of the equity times the return on the equity, which is up here, plus the weight of the debt times the return on the debt times 1 minus the effective tax rate. So you've got a weighted average cost of capital of 6.83%. Right, now let's just see, I'm going to just do a search on Google and write Carrefour WACC. And you've got just here, as of today, the weighted average cost of capital is 6.96%. What do we get? 6.84%. So within very short period, I've been able to calculate, oh, I've written the exact same thing, no, that was 6.96. Within a very short period, 15 minutes, I've been able to calculate a weighted average cost of capital using some assumptions, yeah, a bit dubious assumptions, but still some assumptions, to get a very close weighted average cost of capital to that has been found by analysts on the internet. So let's go back to our presentation. So we've gone through in lightning speed how to calculate the weighted average cost of capital. I use Carrefour. Using real data, sometimes you can get difficulties, but the approach that I use can really normally get you to quite close to a weighted average cost of capital that others would take a long time to calculate. Thank you very much.